Welcome back to the What the Halo podcast. I'm your host, Dave Townsend. As always, please hit that like and subscribe button. It does let us know that you like this. Today, I'm joined by Kris Konrad of Piton Investment Management. Before we dive in here, Kris, why don't you just give our viewers a little quick overview, who you are, a little bit about Piton. We'd love to learn a little more.
Sure. Thanks, David. Thanks for having me on. My name's Kris Konrad. I am one of the founding partners and managing members of Piton Investment Management. We are a boutique fixed income manager that caters to ultra high net worth individuals, specializing in SMAs.
So I brought you on today because I gotta be honest. One of the more interesting things that ideas I've stumbled across recently is this idea of uncorrelated income, which you guys had turned me on to. And it got me thinking about, there was a financial advisor from the 80s. I know this is a little bit dated, but his name was Harry Brown. And the permanent portfolio was essentially what he had created. And it was as a product of as a response to the 70s where there was an inflationary environment. And so his response was this permanent portfolio. And the significance to it was essentially equally weighted 4 parts: growth, stocks, bonds, cash, and gold. And the idea was to say it was kind of a 4-quadrant approach where, regardless of the macroeconomic environment, that this would perform well in any environment. And of course, today that there's been spin-offs of like a cockroach approach, I know from the guys at Mutiny Funds and so forth. But the significance here is that at the end of the day, the idea was here is what Harry was up to, is to say so much of portfolios are geared towards pro-growth, pro-GDP centric. So most of their sources of income, growth, however we want to define it, all kind of come from the same place. Said a different way is that they're really kind of geared to, I know it's around the time of the Super Bowl here. I won't ask you who you're rooting for, but portfolios are generally designed today to be very GDP centric, very growth, and they kind of get, most of the outcomes are derived from the same place. And so when I stumbled across this idea of uncorrelated income and what you guys were up to, I was really, really intrigued because it was finally a true alternative to say stocks, bonds, REITs, venture capital, private equity. At the end of the day, they're all all gas, no brake, all offense, no real defense. So they're deriving the income, the investment income that these produces from all the same sources. And so it really got me, I was really intrigued by this idea of uncorrelated income, which you guys are up to. Can you break this down for us, or help me make some more sense? Where did you stumble across it? Why do you like it? Why are your clients looking at it?
Great question, David. To me, when investors in ultra high net worth individuals look to purchase income, as you mentioned, they are typically going into the markets to buy yield, and specifically the U.S. fixed income markets. So this ranges from ultra safe U.S. Treasuries, and then all the way out to down in credit. It can be deep credit, it can be private loan markets. Obviously, the more risk you're taking on, the more yield. But another place that income can be farmed is from volatility, essentially selling options on underlying securities. Yep. This can be in the form of single name equities or even broad market indices. And these markets tend to not be as correlated to interest rates or other traditional forms of income or yield providing securities. And sometimes in the case of single name equities, they can even be uncorrelated to the overall direction of equity markets.
Yeah, and there's so many. I mean, obviously, JEPI, the likes of JEPI and the covered call, and it isn't exactly. What's interesting is that it isn't a terribly new product, but the proliferation in the past several years is interesting. Given that maybe it was for the longest time something of an institutional oriented thing, and like all other advancements, maybe retail investors are catching on now more frequently. But what's interesting, so why use structured notes? I know you guys prefer structured products as a wrapper, more specifically structured notes to kind of as the wrapper or vehicle to tap into this opportunity. Why do you think structured notes versus the numerous other ways you could do this?
Well, I think you really hit the nail on the head there. It's really about the wrapper. And for these transactions, which in the case of income-oriented structured notes, you have sales of long-dated options, you have purchase of zero-interest bonds, and through the mechanism of creating a note, hopefully using the Halos platform to do this, you are essentially getting a bundle of all these parts. So essentially, at the end of the day, it's gift wrapped and sold in the form of a security by the issuer.
Yep. So let me put you on the spot here, and you could very general, high level here, because obviously one of the like main criticisms folks will say or people get, and I get it to some level, transparency is difficult in certain financial products. It's like cost wise, and I know you guys with fixed income pedigree can really weigh in on a deeper level around cost and so forth. And so everybody thinks about, they look at these like, the low cost. Everybody, just simply because something is low cost doesn't mean you're getting any real good value or you're getting a good product. That we could go all day about what that means. But like, as you guys think about structured notes to tap into some of these opportunities, how are you guys kind of thinking about fees or cost or value, I guess, more specifically relative? Because you guys are smart. You could do this with, like you said, options, be them listed, unlisted. There's a million different ways that you can manufacture a exposure. And when you're thinking about value and cost, where are you guys at in terms of like structured notes?
Sure. No, great question. At the end of the day, it comes down to execution. And certainly when you're talking about trading long dated options, the bid ask on that stuff is generally much wider than shorter term, near term options. So there is an execution cost there inherently. And then, as you delve down into products that have a lot of yield associated with them, so the further you are going away from U.S. Treasuries per se, the bid ask on that type of product generally gets wider as the risk profile goes up. So from a cost perspective, structured notes have, yes, always been thought of as a very high cost product. But when you compare it to the characteristics of other like products that are, have commensurate returns, I don't think it's too far off. And certainly in more recent years, as the proliferation of structured products and structured notes has increased, costs have come down. So that's, I think that will continue to be the case.
Yeah. And I get, like all things, there's just so much misconceptions about things and dated kind of thinking. So, which brings me to a question here. I know this was off the script, Kris. I just literally thought of this one. If you're sitting around in a casual setting, say we're with a bunch of like-minded investment types, and what would be the one thing you would tell folks about structured notes that maybe they don't really know, or the one thing that they should know, when thinking about maybe clearing up some misconceptions and so forth? Is there anything that jumps out at you to say, hey, guys, this is really, some dated thinking. Here's how really, these things are used in 2025 and so forth?
I think people with high market acumens will always say, yeah, I can essentially build a structured note myself by accumulating the parts. But at the end of the day, there's a lot of work involved in that. Selecting the options, selling the options, getting execution on zeros. So there's a lot that goes into it. I think to have it gift wrapped by the issuer and provided in the CUSIP, it's absolutely worth the cost, in my opinion. And I think that's what people, especially intelligent market participants, I don't think they appreciate that to that extent.
Well, it's funny. I was just reading an article. I think it was like maybe from BNY, Boney, I forget, so like a study, and it was that there were a survey that they'd asked a bunch of advisors, and what was kind of an interesting output was because everybody knows the typical advisor is doing 100 things, right? And like we underestimate the value of like convenience, right? Like they just like people are busy and the more complicated the product, and like you said, like it's bundled up, something that sometimes when you get a nice tidy bow on it, even if it does cost you a little bit more, I think the smart people, smart money knows that you're getting value for something like that.
I agree.
So last question here for you, just kind of zooming out a little bit, because you guys have such a strong background in fixed income markets, generally a very, a strong pedigree. Just when you think about structured notes, and especially in the search of yield, right? Why do you like structured notes relative to the many other fixed income options that are out there today?
Sure. First and foremost, it's the outsized yield.
Yeah.
It's very easy to structure income notes off of widely held names, names like Uber, Google, Coinbase, Oracle, and, any of the names that are constantly being talked about on CNBC or whatnot. It's very easy to structure notes that have double-digit coupons off of those names. And, the great thing about especially Halo's tool is that you have the ability to structure them however you want them. You're able to structure them with monthly coupons as opposed to quarterly or even biannually, which is commonplace in the corporate debt world. You can embed calls that, will further increase coupons. So to me, these, when compared to say single B or triple C credit that you'll find in any junk bond ETF or even, in the very hot private loan market, which has, been all the rave the last few years, you're talking well into the double-digit coupons versus 7 to 8% in those other areas. To me, from a risk-adjusted return standpoint, I would much rather prefer that.
Yeah, I always challenge people. Okay, here, do me a favor. Go find me a product that offers double-digit returns, and I get to customize the terms and so forth, to some level, really dial this into my preference. And I'm still waiting for people to come back with another financial product that can deliver.
That's true.
Well, hey, Kris, it's always great catching up with you. We really, as always, man, we appreciate your time today, and we look forward to speaking with you again.
Yeah, thanks, David. Thanks for having me.